Hi out there, this is Craig, the options linebacker. This is the weekend report for Sunday, February 13th. We'll start out this report with the Dow Theory Twins. We have the Dow Industrials on the left-hand side. We have the transports on the right-hand side. Last week we talked about a potential disconnect between these two, as the Dow was certainly making higher highs and higher lows, although the transports were lagging and had made a potential lower high. But that seems to be clearing itself. And if the transports are able to get over this level of 52.56 and create a new higher high, then we will once again have confirmation in Dow theory. Now let's do a top-down analysis on the S&P 500 starting at the monthly chart. On the monthly chart, we're not seeing a whole lot of detail here other than the fact that we're in now wave 3 of a primary cyclical bull market. I know there's a lot of bears out there that want to think that this is just an ABC correction in the middle of a secular bear market. But to me, after we went above the 61.8% retracement and did create a new higher high, and this looks to be very strong price action, I think that theory is dusted right now. When we get into the weekly chart on the S&P, this is where we see a lot more detail. Now, first of all, let's go back to this summer. At the end of August, what we talked about was the potential, and I know that wasn't very popular at the time, but I said, look, we have an inverted head and shoulders pattern here, which is going to target somewhere around S&P 1240 if it's able to do that. Well, it certainly did that, and we got up to S&P 1240, and that was around the late fall December timeframe. Now, the next thing that we saw in here was this larger cup with handle pattern that has a breakout level right around that S&P 1220, 1230 area. Now the target for this guy is going to be somewhere around upwards of 1400, and it looks like right now the price is in the influence of that pattern. Now if you really want to blow your mind, take a look at this. We have a much larger cup with handle pattern, which has got that neckline of right around 1230 again, and this would lead to a potential target up around S&P 1700. Now I know that that's blasphemy to mention something like that right now, but that definitely comes under the realm of trade what you see and not what you think. Now on a more granular basis, what I've noticed about the S&P is that it tends to be very consistent. Notice how we came off the bottom, made a 289 point swing. Wave 3 was a 281 point swing, and then of course wave 5 was a shorter swing higher than that. Now the first wave that we had off the bottom this summer was in the middle of a corrective period, so accordingly it was very short, but this wave now has just exceeded the initial wave off the bottom in March of 2009. We now have a 291 point wave. At this point we just don't know how much higher it's going to go. In fact, this is the strongest weekly wave that I've seen since the old late 90s bull market days. Now we're going back to the time frames of like 1998 and 1999. Now we did have a corrective period back here in 1998. This is the long-term capital management issue that we had, and that created much higher prices out of there. In fact, this created an almost 500 point swing on the S&P in just about 9 months. So these swings were taking about 9 months. You can see that this one was only 332 points. What you'll notice about these is that they have plenty of sideways action interspersed by range expansion and then range contraction, range expansion. This is normally how price action works. And even this 495 point wave had very strong initial range expansion, contraction, expansion, contraction, and once again expansion before contraction, and then the final expansion higher. So that is how normal markets move. What we're not seeing in this particular market is any kind of contraction or consolidation patterns. We're seeing extremely strong price action. We had a very brief consolidation in the November timeframe. Since then it's been straight up. We had a one-day wonder a couple of weeks ago on that Friday with the Egyptian fears, and that's led to a 55 point move higher since that point. The rule of the day is just to buy the dip. Now when we zoom into the daily chart, we really lose any kind of perspective in what's happening here. All of the indicators are showing just false signals. We see all kinds of crosses on here on the stochastics. Those have all been faded to the upside. Our MACD histograms are not working, and the only thing that's relatively working is the Bollinger Bands are keeping the price in check. Anytime the price goes outside the bands, it tends to get pulled back inside, but not by much. So we can make a case right now that really technical analysis, unless you're using it on a much larger scale, like the weekly or the monthly time frames, is just not working. None of the signals that most people have learned about over the past few years are really doing anything at all. However, what I'm noticing that still never goes out of fashion is good old-fashioned price action. So understanding price action, we'll show that in a minute. And then also understanding fractal energies. Let's take a moment to talk about price action. We'll go back to the important weekly chart because this is really where the action is happening right now. Now, all the bears out there keep trying to catch the top, and this is really why the price just does not go down, because they have weak hands right now, and every time that they're getting the end of day ramp, they're being forced to fold, and it's just the most predictable pattern in the world these days, is that we have a morning fade, and then we have a short squeeze the rest of the day. It just happens day after day after day. And right now, until bears stop trying to pick the top, it's going to be a continuation of that. Over the past 2 years, it's been the same pattern, with the exception of last summer. So what should bears be looking for right now as far as price action? Well, the first thing that they need to understand is that before this is going to roll over and go back towards their hallowed goal of S&P 200, we're going to have to take out a lower low, first of all, and then create a lower high. And that's nowhere near creating that yet. Let's see how this started back in 2007. Okay, going back a couple of years, as we went in through 2006, we had a very similar type of trend. It just never quit. And then finally we had a one-day wonder here. We dropped about 50 points, and that started a small corrective period. You'll notice that the price actually went up much faster after that. This is what will happen once we finally do have a corrective period, is that we'll probably end up with higher prices. So you'll notice that the market didn't just immediately go into a bear market at that point. What has to happen first is instability has to take hold. And that usually starts with one of these corrective patterns that's very deep and actually creates, in this case, a lower low. And then we'll rally up to a higher high. But eventually what happens is we will hit a lower low on the weekly chart, and then a corresponding lower high, and then it's all over from there. So all you guys that are trying to get the jump on the bear market that's just around the corner would just stop it, wait for the lower low, and then wait for the lower high, and then it'll be time to short. If you want any examples on that, read about Jesse Livermore that went bankrupt once because he kept trying to hit the bear market, and he was actually just a few months too early. Still in the middle of this cyclical bull, when it's ready to go down, it'll let us know first with a lower low and then a corresponding lower high. Now, the only indicator that I have that's really working outside of price action is what is known as the consolidation indicator, which measures fractal energies. So I'm looking at the monthly chart, the weekly chart in this case, and when we have a high reading here, what that means is that the chart's full of energy at that time frame. When we have a low reading like this below 35, that means that that time frame is out of energy. So in this case, we are right in the middle of a monthly trend. However, the weekly chart is finally played out its hand. So now we go down to the smaller time frames like the daily chart and the 150-minute chart, and we can see that the daily chart still has a little bit of energy left in it before it goes under 35. So we might be able to squeeze another 10 to 15 points out of the daily chart before it too is also exhausted. And we can also see that the 150-minute chart will support that 10 to 15 point move. And then once we get up to that point, we will have all three of the lower time frames completely exhausted, which will support the thesis of a potential consolidation zone or a retracement. That's all the time I have for today, folks. We'll catch you next week. Take care.